signal and I missed it. So I apologize for that. Welcome everybody to our market update webinar. Trying to answer the question about stocks saying the economy is turning, and are they correct after we've seen this very rapid recovery from a very oversold position in stocks just a few weeks ago. And I'm joined here today by my colleagues Karen O'Neill, Debbie Shog, and Rita Lee, and we'll be here to take questions. The format for the questions, and if I get this wrong, please text me, Caroline, is that there should be a place for you to write in your questions and comments, and we'll be able to see those, and then we'll be able to answer those. And hopefully we'll have plenty of time to do those if we don't cover them during the presentation. I'd just like to start out with a difficult subject, and that is that, of course, the civil unrest, as it's euphemistically called, over the last few weeks has been something which has affected us all. I think looking at the images and videos of people on the streets and realizing just how big this movement has become is shocking, in that we often think of America as equal opportunity when clearly it isn't, and there are large parts of our society which have been marginalized and disenfranchised. And we all know the statistics on inequality in the country. And I think some of this is the manifestation of that, of course, as well as the most immediate reaction to the case of George Floyd. I don't have an answer. I wish I did. I'm struggling with the events, as I suspect everybody on this call is. I do know that as long as we have the kind of inequality that we do have, we're never going to get the best out of America. And we have a very good deal with America. We have a very good enterprising capitalist system that has done very well for very, very many people, but it's also left some people out. And I think we're seeing some of the reaction to that. And I think all of us in our communities and our leadership would like to do something and looking to do the right thing. But as I said, I don't really have an answer for it, other than I wanted to use that as a forward to explain some of the events that we're seeing unfold between us, in front of us. With that, please could we go to the first slide, Debbie? And we'll go from the beautiful view of the Golden Gate Bridge to kind of where we are in June 2020. So these are the kind of biggest points. I think we've seen an absolutely unparalleled decline in the real economy and labor participation and output. And you've heard many times that this is unlike any other recession. It truly is, because nearly every other recession has some sort of bubble in it, whether it's the obvious one of real estate and over-leveraged households in 2008, 2009, as well as extremely over-leveraged and bad-performing banks, or in 1999 with the dot-com boom. Anywhere you go back 70 years or beyond, you'll find some part of the economy which has got out of control, and there's been some reaction on the part of a central bank to halt that part of the economy, which is clearly in some sort of bubble. And it could be inflation, it could be output, it could be in prices, it could be in wages. But this is unlike that. This is like 20 million people just switched off the lights and went home. And so it was a decline in the output side of the economy, people who make things, and in the demand side of the economy, people who actually buy things. So everything we're seeing right now, the precipitous decline and the rapid recovery is unprecedented. And no one, we can do our best to sort of tie it back to other experiences that we've seen, but really everything we've seen is for the first time. That's kind of the realities of what we've been dealing with. I think first up, the Fed action forestalled most of the worst. Obviously, they came out on a Sunday, I think way ahead of the game. They did very swift action, took the Fed funds rate down to zero, basically launched an army of different programs to make sure that there was liquidity and solvency in the system. So they stood as a backstop for just about every major security out there, including the obvious things like commercial papers, which can cause bank runs, corporate bonds on both the issuance side and the secondary market, mortgage-backed securities, treasuries, of course, money market mutual funds, and even some ETFs. So basically, anytime there was a likelihood that one part of the capital markets was getting into trouble, the Fed stood there ready to make a market in them. And they did, as I mentioned before, in less than a week, what took them 9 months to do in 2008, 2009. Who thought they would have had to repeat such a emergency policy so soon after the last big financial crash? But they did. They learned it well, and right now they're standing behind as buyers, particularly of treasuries, which we'll see in the interest rate outlook in a minute. The stimulus packages did their parts as well. We can argue whether they hit the right places at the right time, whether it should have gone more to the consumer, less to the companies. But it was a lot of money, and a lot of it ended up in the right places. I think particularly the unemployment benefits, the $600 increase, the extension of unemployment benefits, the $1,200 sort of check out of nowhere, and all this did help, as did the PPP. So I think that the fact that there were three of them, of which the third was by far the largest. There's talks of another one to help out the states in particular and local governments. So these stimulus packages did make a big difference. And then the recent improvements in the economy are real. So yes, the market has retraced nearly all of its gain to January the 1st, not from its peak. It's still about, on the S&P, the peak was about 3,400. It's today around about 3,200. But remember, it got as low as 2,200. So we've retraced an awful lot of the fall. We're not quite yet at the peaks, but there's no doubt that the improvements in the real economy are real. And we'll talk about that a little bit as well. But there's going to be more bad data before it gets going. I think we're going to see more on the unemployment side, despite Friday's number. We're still going to have a rush of bad industrial output, bad export numbers, bad investment, bad inventory sales. I mean, they might all be better than the retail sales, wholesale deliveries, all these touch points of the real economy. There's likely to, continuing bad data. It might be slightly better than what looks like the trough in late April, May, but I wouldn't count on it. So we'll still see more of that. And I think getting back to the output level that we were is probably going to take at least another year and a half, and that's assuming everything goes well. Even if we got the unemployment numbers and the new jobs numbers cracking along on a monthly basis like they did on Friday, which is highly unlikely, but let's say we did, it would still take the best part of a year to get down to the February unemployment level. So it's going to be a long haul. Anyone who expects this to snap back and we'll all be sort of back in clover by the fall is just deluding themselves. But it's at least on the right trajectory. I don't think unemployment will fall below 10% this year. The number we got on Friday was 13.6. It was an improvement on the month before, but as you see, I think it's an enormous task to get that number much below 10% during this year. There's just still too much uncertainty. And I think the recovery in the risk assets, so really we're talking about the S&P 500, the kind of big daddy of all the stock markets, the biggest and meanest and baddest. Other risk assets haven't recovered quite as well. High yield has, some corporate bonds have done well. Some are just getting back into their stride. But I think the recovery in the risk assets is justified. Most of it, not all of it, but most of it. I think things should settle down for a while, and we'll see a rotation into other risk assets, such as small company, mid cap, and international, from the first recovery that we saw in the S&P 500. Okay, can we go to the next slide, please? So who remembers this? These are all headlines taken from the week of March the 23rd, and someone in the bottom right got it right. It's actually excused, but covered up. But that official with the spaced out hospital beds, actually talked about 100,000 virus deaths, with back in March would have considered just alarmist. But so that's where we were. You can get all the headlines. This is the Financial Times. It's not prone to exaggeration, but we really didn't know what we were dealing with. We had the interventions from the central banks. The fear grips global markets. Yep, I can certainly attest to that. There were people who just had no idea what to do or how to do it. The Fed action really it helped a little bit, but initially it was, well, that's not enough. We don't know the extent or the size of what we're dealing with. So that's just March the 23rd. Let's keep going. And since then, I'm afraid we're going to show you some bad economic data. So this is the weekly jobs claims numbers. Normally, you don't really look at weekly job claims. These are just people who, for one reason or another, have lost their job. You're entitled to claim for unemployment if you lost your job, not if you quit, but if you lost your job. And basically, it's been ticking along at about 220 to 230,000 for many years. That's the bottom left-hand side. If we drew this to scale, this chart would look more almost ridiculous, because I've had to put it on a log scale, because when the first big claims number at 6 million is whatever it is, 20 times bigger than the 220,000 number in the bottom left-hand corner. But there you go. You can see it even with the log scale that we got there up at 6 million. And it's been gradually trending downwards. The black numbers on top of the blue bars, you can see last week we're at about 1.8 million. And then the other number is the 3-week moving average, just so that we can see that going down as well. But these are, very big numbers. And just for the record, the largest record weekly jobs claim ever was actually roughly about the same. One was in 2009, one was in 1982, and they were about 800,000. So this just, scorched right through the past record by a factor of 7 or 8. So that, we're really dealing with big numbers. Claims are the most, people file for a claim. We know that. It's not a number which is due to revision. There are some states which report on different bases, which can make the week-to-week numbers slightly odd, but basically this is a good number. This is a real number. And there's some talk that some claims are bogus, and that people earn more on unemployment than they do on job. And that's absolute rubbish. If you are entitled for a claim, you're usually going to get a claim. It's very unlikely that it's going to be turned down. So these are you add these numbers together, and you've got about 42 million people who have had a job and now went to their unemployment benefits offices and said, I don't have a job, and then they will get some level of benefits from that. So those are scary numbers. That's what we were dealing with at the beginning, because all the other historical data, all the other data was way in arrears. We were having to deal with them as much real-time data as we could get, and the weekly jobs claims was one of the best ones. Okay, the next slide. This is this is the New York Federal Reserve. They do a weekly economic index. It's put together by a number of different factors. So between about 2010 and 2019, we basically bumped along at about 2%. This isn't meant to be a GDP growth number. It's just telling you all of the different kind of economic indexes that go into this secret sauce. Tells you the kind of growth level of those economic indicators. And we were sort of bubbling along at about 2%. And that was roughly the growth we got from 2009 through to February of this year. Yes, there was a big corporate tax increase at the beginning of 2018, but all it did was bring demand forward. And we never got the 3% GDP growth that we were promised, and we never were going to. It's really been a 2% GDP world for quite a while now, but then you can just see it just fallen off a cliff. If you kind of, squint your eyes, you can also see that down at the bottom, we've got a little bit of an up and a down. So that's just some of the data struggling with, what's real in terms of recovery and what's not. But anyway, the numbers way down, as you can see, and a lot of these graphs these days look like this. Can you go to the next one? And this is the change in non-farm payroll numbers. And again, we were happily going along at about 150,000 jobs a month. Sometimes they were lower than that, sometimes a little bit higher than that. Could be seasonal, could be some tax issues. But then in March, we saw the, again, this is a log scale, so it went to like 800,000 and then it went to 22 million. And that was obviously by far the biggest number of job losses reported any one month. There's some difficulties with the way this chart, the non-farm payrolls, which basically measures the number of new jobs or not new jobs lost in this case, and the claims are slightly off from one another. They do tend to kind of even themselves out over time. We saw that black line is important. That's the underemployment rate, not the unemployment rate. The unemployment rate is 13%. Everyone, knows that number. But I think it's more important, or as important, to look at the underemployment rate, which is the sum of unemployment plus people who would like to work more than they possibly can. So if you've got someone who does housework at a hotel for 4 hours, Monday through Friday, and is capable of working more and wants to do more, but can't find the job, doesn't have the skills, can't get to work, that would count in as the underemployment rate. And that number is pretty high. And you can see it at 21%. And that's much better indication of how much demand we've lost. Then on Friday, we got the $2.5 million, talk about that, 2.5 million new jobs. So again, forgive the log charts, that looks much bigger than the downward one, but basically that 22 million is the shocker, and the 2.5 million was a surprise. We'll see if it holds through for June. And of course, the PPP program and some of these supplemental unemployment benefits expire at the end of July. So unless they're extended, that number is probably going to go up. Okay, next. And then this is the GDP numbers. Now, in the first quarter, we really only had a month of COVID, even less, but it was enough to knock the GDP growth rate. This is annualized growth rate, so it's quarter to quarter, but then times 4 to make it annualized, was down 5%. And we hadn't had a negative quarter in quite a while. And what negative quarter we did have was extremely small. So then it roared down to -5. The Atlanta Fed and the New York Fed, but I prefer to use the Atlanta one, also put out a GDP now forecast. So they take a bunch of different data and throw it into a model. It's actually pretty accurate. You can look it up. Just type in Atlanta Fed GDP now if you want to track it. It's kind of interesting site. But anyway, they've got it coming in at 53%. Now, negative 53% for this quarter that we're currently in. Now, just so that we know what we're dealing with, it doesn't mean that the economy is going to go from $22 trillion to $12 trillion. What it means is that the quarter to quarter downward growth rate will be about 12%. And then they've annualized it. So if you have a 12% fall in one quarter and then you annualize it, that's how you get to the 53. So we're going to see, a very big number and it's bad. I'm just saying that it doesn't quite mean that the U.S. economy is going to halve in size, because if it did, we would be there would be all hell to pay. But anyway, but it's a bad number, and you can see that that's what the Atlanta Fed is forecasting. We won't get the first number till the end of July. Obviously, the quarter doesn't end for another 3 weeks, and then usually we get the first rough estimate around about the end of the following month. So look for July for these numbers to start showing these up. But the stock market investors are way ahead of this, and so in some ways, when we get the numbers, they probably won't be much of a surprise. Okay, next. This, I think, is important because in light of what we saw on Friday with the 2 million numbers, 2 million new jobs, this is really what we got to focus on. Bottom line, we know that 43 million people filed for claims. So that means 43 million people had a job and they don't have a job. And we also know we have about 21 million people unemployed. So what happened to the difference between the two? Well, I think what's happened is some people have taken themselves out of the labor force. So that blue line says that the number of people who participated in the labor force was round about 60%, and it's just dropped to 52%. So So 8% on a labor force of 158 million, as it was, is what that's about about 9 million people. So basically, what we've seen is 9 million people take themselves out of the labor force, and they might not consider themselves unemployed because they might be furloughed, so they might have a job but not being paid, and then they get a call back, and so they're back at the job. So they're not technically, unemployed, but they sure as heck are not earning money, and they are also taking demand out of the economy. So I think this is the number to focus on, not necessarily the unemployment rate. And if you kind of add all this together, you've got around 36 million people who used to work and wanted to work and now are not working and can't work. So that's really the size of the slip. Now, if you take 36 million people out of a labor force of 158, as it was, now down to 137, you're going to get a big drop in demand, for everything, retail sales, travel, you name it. There's just, roughly that number of people who don't earn a wage anymore. So that's what we're dealing with. And this is what we've got to try and fix, obviously, with the various different programs and the reopenings and getting people back to work. So yeah, the numbers on Friday were good. I think they were slightly overstated, but this is where the action really happens. And this participation rate is, well, I've taken it back 30 years, but if you took it back, probably, another 70 years, and it would still be at an all-time low. Okay, next. But I did say that the economy is recovering, and the trouble is this is moving so fast that the real economic data, the stuff that the Bureau of Labor Services gets, the Census Bureau gets, the different, the energy departments, all these economic statistician places, they tend to do with a bit of a lag. I mean, they get them faster than any other economic bureaucracy in the world, but they still get them with a bit of a lag. So what we've been looking at is the high frequency stuff. Normally you don't bother with this stuff because you don't really care how many people go through TSA on a normal day. But, when we're trying to ascertain what the economy is doing in real time, we kind of get to this high frequency data. So here's a couple of them. Top left-hand side, TSA checkpoints. So a year ago, there was about 2.5 million people a day going through the indignities of taking off their shoes and socks and belts and having their water glasses taken away from them. Now it's about, it's just under 500,000, you can see, but you can see that bottom red line is beginning to slope up. So this is, a huge decline from the peaks of last year. There's no doubt this is not an industry which is about to bounce back with a high degree of health at any time soon, but it's beginning to come off the lows. And the reason it's kind of zigzagged is because more people travel on certain days of the week. That's all that is. So, but you can gradually see that that's going up on the left-hand side. Below that, this is Open Table, the restaurant booking guys, and obviously they went from just dropped to zero. You can see they were down 100%, bottom left-hand corner, basically March through beginning of May. And you can see that there are a couple of various states there. Some are more liberal on the reopening than others, but gradually those openings are coming back up again. So that's a good sign. The top right-hand one is, if you have time on your hand, this is a really excellent website called Flight Radar, which you can look at, all the planes are in the sky at any one time. But again, the top line is all flights, and the bottom line is commercial flights. And the difference between those two is that there's an awful lot of air freight going around the country. You tend not to see it because the Texas, because FedEx and UPS and these guys fly at night, weird times of day. And they take off from strange airports, but basically you can see that both plummeted, and you can see them again slowly coming up on the right-hand side. So this data is real, as is the last one here. Hotel occupancy rates, you've got them for the last couple of years. The black line in 2009, and then kind of various medium numbers, and the year before that, and now you can see that they fell off a cliff again. From weeks 10 of 2020, so around March, middle of March, and now they kind of got a hook back up again. This is not at a rate which hotels are going to make a lot of money, but you can see that that occupancy rate went from 20, up to 35. So this frequency data is pointing in the right direction. And let's look at a couple of more quickly, because I do want to sort of, draw this link between you can do the next slide, this bit between that, is the stock market way ahead and the economy, way behind? And it's like, well, there's some very good indications that no, they're not. This is another interesting website. We don't usually look at things like this, but this is Apple. If you just type in Apple Mobility, you can actually type in your own zip code and state and town, just see who's on the move. And what this shows is that inquiries for people who are doing travel, you can look it up by walking or public transport. You won't see much on public transport. This is driving. So this is, how many people went in and said, how do I get from point A to point B driving? And it fell 80% in the States, Germany, Italy, United Kingdom, all big lockdown countries, some more than others, especially with the United States, was very varied. But slowly they're getting back up and more people are traveling. It's also showing up in gasoline sales. So, people are on the move. And then next slide. California's a little bit more cautious. United States was way ahead of that, but then California started early and it's still got some of its reopening behind some of the other states who had a different experience, different outlook, and different philosophy on closing their various markets. But it is on the uptick, as you can see. Again, it's zigzag because it's not going to account for seasonal variations, and people are going to drive. They're more likely to do it on a Saturday, Sunday than they are on a Tuesday, Wednesday. But that's all in the right direction. Okay, next. So we got this link that things are beginning to look better. Here are car sales. Normally that top black line, the US was trundling along at selling at about 18 million units. The axis is slightly different. Sorry, the blue line is all total vehicles, which adds up trucks and cars. That was about 18 million. It just dropped down to about 8 million. And then it bounced back up to 12 million. And roughly we buy, 3 trucks for every car we buy, because we're kind of a truck driving nation. But anyway, that at least you can see them all hooking back up, especially on the truck side, which are perhaps more work related if you're buying your Ford 150. But again, this is another indication that, it's, the stock market said the economy is getting better, and we've gone through 5, 6, this is our 7th indicator. Yeah, it seems to be right. So let's keep going. And again, this is coming back to, now we're sort of switching a little bit gears into the capital market. So we've established that the economy is coming back, could come back faster. It'll be slow. The numbers are going from a very low base effect, so they're going to look great for a while in percentage terms, but they're still way off their peaks. But this is one of the reasons why, the Fed took rates down aggressively last year for normal policy slowdown purposes, and then just took it down to 0. And had all these other programs in place. And you can see the drop in the 2-year rate, which is that bottom one, where it was actually a time last year where we were getting quite decent money on the 2-year treasury, whopping 1.5%. And now it's 20 basis points, almost not worth investing for return purposes other than return of capital purposes. And the 10-year, actually, it's a bit lower than that. That was a weird spike the other day. It's about 75, 80 basis points. And then if you go all the way out to 30 years, you get, 1.68%. So I think this is going to stay this low for a while because the Fed is keeping rates down. They're also doing something called yield curve control, which basically means if they see one part of the yield curve, here you've got a 2-year, and then the 10-year is above the 2-year in the yield curve, and of course the 30-year is above the 10-year in the yield curve. If they see any part of the yield curve moving too fast, they'll just start buying into it and trying to reduce the price. So we're likely to see these low rates for a while, which is great. Who wants a monetary contraction and a high rate environment in the teeth of the biggest recession we've ever had? And thank God that the Fed is sort of on its own policy here and stands ready to be as accommodative for as long as it takes and as much as it takes. So hats off to Powell and team. Okay, next. So this is the S&P. So we've obviously had a wild roller coaster. So there you see, going back to 2007, we saw this big drop in the S&P from around about 1,500 down to 650. Then we clawed our way back up to 2015, went sideways for a while, had a great 2017, pretty much all the way through to 2018, and now we've just had this big zigzag, and now, as I mentioned, we're kind of back where we are. But I remind people that the stock market is a heck of a lot more volatile than the dividends that the stock market throws off and the earnings that the stock market throws off. So these numbers might be off a little bit. People have not quite tallied all the numbers, but you can see that the dividends are down a little bit. They peaked probably around about $62, $63, so they're down to 59. So that's with all of the dividend cuts that we've been hearing about. Total dividends on the S&P are not down nearly as much as the stock market was. So that's why we like dividend payers, because they continue to pay normally, even through tough times. And on the earnings side, yeah, it's down. We peaked, that's that blue chart, earnings per share on the S&P 500. So a big acceleration in 2017, 2018, nearly all of that increase is due to the tax cuts rather than underlying earnings growth. But they kind of flattened out for 2018, 2019, because we did all that nonsense with China. And now, the earnings are beginning to come through. So you might ask yourself, gosh, I would have thought there'd have been a lot less than that. But there's a lot of companies which still, make their earnings. Their growth may not be as much. They might be anticipating slower growth ahead. But so far in the first quarter, at least, we've seen, earnings come down as expected, but again, not nearly as much as the price of the S&P. So earnings, very important to remember this, earnings and dividends much more stable than the price. Price is where all the where all the sort of where all the craziness happens, but the dividends and the earnings are a lot more stable, and that's been good to see even in this correction. Okay, next. These are some of the corrections. So this is the S&P as of Friday. You could update it. It's 3217 up there. It's now 3232. So again, we've come back, precipitous decline, and up we go. Let's have a look at some of the other risk assets, because the S&P, I think, is not the most interesting story here. This is interesting. This is the small cap guys. They were near an all-time high, but and they fell a lot more. They fell more like 45%, and they're not back up there yet. Small caps reflect far more what's going on in the financial world, and they reflect far more what's going on with more leveraged companies and domestic US economy. The S&P 500 has a much more cash generative set of companies and a lot less leveraged loan dependency and a lot more international and global coverage. So this is really what's going on in the heartland, if you like, what's going on to reflect the US demand. This is much more indicative of what's going on in the US. So we think there's more to come. The numbers are actually for the small cap over last month were pretty impressive. They were up about 13, 15% more than the S&P, which is more like up 9%. So they've begun to recover some of their growth. I think there may be more to come. On the next slide. So now NASDAQ's another story. NASDAQ is very badly named. The NASDAQ is just one of the stock exchanges, but the NASDAQ 100 is rather tech heavy, and it has the Microsofts and Apples and Visas and all those kind of guys. And this has done incredibly well and has actually reached a record high. Now, there's a good reason for that. These are companies which have quasi-monopolistic profits. In many cases, the enormous amounts of cash flow, not a lot of fixed overhead and expensive, very good numbers on things like earnings per employee, sales per employee, cost per dollar sold. I mean, these are not labor-intensive businesses or capital-intensive businesses, and they've done incredibly well. And they generate a ton of cash, and they sit on a lot of cash. And they're also good businesses. So this isn't just the Facebook, Apple's, Netflix, Google's. There's other good companies in there which have the same sort of characteristics. So we like these types of investments. They tend to run. They always they've done extremely well, and but I think their growth outlook is still very robust. So despite that return to a peak, we still like that. And then the last one is Debbie, is the euro. This is the big euro stock. So this is companies like Nestle and L'Oreal and Roche and GlaxoSmithKline and SAP, which is a software company, Sanofi, Louis Vuitton, Moet Hennessy, big consumer goods company. These are very strong companies, global companies, and again, they took part in the downturn, and they're beginning to recover quite nicely. They kind of went sideways. The US, compare this chart with the US one. The US one was much more a gentle kind of V all the way up. This one kind of went sideways for 6 weeks. And I think what's going to happen is that this will continue to do well. The ECB is not quite as generous as the Fed. It can't be, but it's doing all it can. And very interestingly, there was a couple of moves over the last couple of weeks where and Angela Merkel and Macron, Germany and France respectively, talked about issuing some EU-wide bonds. I mean, you go into a ton of detail on this, but it doesn't really matter other than it seems to be a concerted effort to try and back up the EU with a little bit more concrete fiscal policy, which they did not do at all in 2008, 2009. Hence you got Germany, Spain, Italy, Portugal, Ireland fallout. That's not happening this time. And I think, part of the European story is still more to be played out. Okay, last one. Next one. Yeah, so where does that all put us? We think, US large caps will remain robust. Doesn't mean we won't get a correction. I wouldn't be surprised on any one day if we saw the market down 10%. If there was a spike in cases, or there was a second wave, or our administration got into another fight with China, or any number of things, or the civil unrest spilled over into more into the economy. So you get something with this well priced, and it could be prone to corrections. But generally, the large caps are in pretty good shape. Small and mid cap have some catching up to do, and we're seeing that happen. We do think rates will remain low, so we are not concerned about inflation. I know there's a whole narrative out there about the US increasing its issuance of debt securities, the budget deficit going high. I'm not trivializing those, but that doesn't mean that they are not compatible with low rates for a very long time. And I don't think we're going to see any kind of inflation in this economy again for a very long time, unless you're a pure-blood monetarist and just believe in monetary growth means inflation. And there are very few of them left. It's very difficult for me to see a consumer going out in this type of environment and pushing up prices on everyday goods because they're feeling confident about their job, their pay increases, and their future. That just does not seem likely in this environment. So rates will remain low. International stocks are beginning to come into recovery. We've talked about Europe a little bit. It's also true in Japan, although they're slightly more wired into the whole Chinese economy, which has a different set of concerns and stories, which we don't have time to go into yet, but we've written about it on the blog. But then the whole things do depend on, yes, what do these reopenings look like? They seem to be on a fairly good curve right now, but as we know, in some states, the number of cases is increasing. That might be because testing has increased. Test more, we get more cases, of course, but the thing to look at is what kind of mortality we see out of that. We can't see any kind of big slippage on that. Get a vaccine, then things go back much more quickly. And then this last one is the social unrest. I mean, if people are fearful about going out in the streets, or they want to take more direct action against government or businesses and boycott them, or there's just more and more people who are very unhappy with the status quo, then that's not going to be conducive to a settled, well-run, growing economy. But so those are not any of these trivial risks, but these are the ones which we think are the big ones right now. But we've still got going with us the Fed, those real economy upturns and upticks, and capital markets in relatively good shape in terms of earnings and cash outlook. That's the end of the prepared remarks. Rita and I are here to just take any questions, or if there's anything that I think there should be a panel to ask questions. Carolyn, I don't know if you could chip in there, or
no questions at the moment.
Okay.
Unless Rita has some.
Yes, hi, Christian. I have two questions that came my way. This is Rita Lee. Hi, everyone. First one. So the Bureau of Labor Statistics have shown that over half of the states have processed and paid only about 60% of the total submitted claims. So that means about 40% has not been paid. Would this mean that the demand for goods and services could have more room to run?
Yeah, I think yes is the short answer. I think especially now, if we talked about this, a month ago, I'd say yeah, but where are they going to, go out and buy stuff? Because if they're in kind of lockdown. So, but I think now with things opening up a little bit, I think there's possibly some more purchasing power out there. And so if some of these claims have been backlogged, then people are going to get, whatever it is, 2 or 3 weeks worth of claims money coming their way. And I think that could definitely help the situation.
Great. Another question relating to the recent IPO markets. IPO markets have been active, and we've got some tickers that I can think of, Christian, like Vroom today went up 100%. ZoomInfo did quite well as well, and you and I have also talked about more CUSIPs for secondary markets for bonds as well. What does it say? What does this say about investor appetite? Are we a little bit ahead of ourselves?
It doesn't seem the most obvious market to time to go for an IPO, I must admit. There's this one Nikola stock, I think, which came out, which went up a lot, and they claim to make electric trucks, but all they've got, so they're kind of competitor to Tesla, but I think all they've got is a mock-up. So there's some in there which you don't want to get involved in. If you mention Zoom, that makes total sense to me. I mean, it's a very expensive stock, but it's everybody. Everybody knows what they do, what it does, and their growth in terms of participation and sales has been astronomical. So that kind of makes sense. I think what else is happening on that end of the market is, we're hearing about people opening up Robinhood accounts, and so for Robinhood, for those of you who may not know it, it's an online brokerage account where you can buy fractional shares and just buy a lot of individual low price stocks. And one of the things they've been buying is, for example, Hertz, which is kind of going through bankruptcy, but it was selling the $100 stock about a year ago, and it went down to 10 cents, and it's $4. Went down to 10 cents last week, and it's $4 today. So somebody has been making, some money on that. But I think that's just a lot of people just sort of playing around, trying to find, short, cheap, underpriced, stocks. I see more of that as kind of investment speculation than anything fundamental. And on the corporate side, I mean, I'm glad to see that, corporate bond issues are getting away. That was really important. And I think what's happened is that, companies have made defensive issues of bonds in order not to run out of cash, not to have to depend on a line of credit. They've drawn down lines of credit where they can. It makes total sense to try and get as much, cash into the company as you can when the times are good. So I think that's all right. I don't think this is an IPO market like 2000, where people were quitting their day jobs and making a ton of money. This it's going on, but it's on a much lower level.
Great. Another question. Many small businesses are not going to make it, and especially restaurants, and it'll leave a lot of folks unemployed and a huge loss to the economy and the real estate market. long-term that should trickle down effect, should have a huge trickle down effect on the economy? What do we think?
I think the worst thing that can happen is there is a dislocation, a permanent dislocation between employee and employer. So that can happen in two ways. The employer goes under, bust, and has no more jobs to offer. So I know the person who asked this question knows this industry way better than I ever will. But there's a restaurant up near us in Nevada called Wild Fox, which just closed down, and who knows what's going to happen. It's a purpose building, so I can't imagine what else it could be used for. But unless somebody takes it on, you can imagine those people are going to have to find some other employment. Now, some might find some might find it, some might move to find it, and some might be disappear into that long-term unemployed, and that is a problem. Long-term unemployment, even before this crash, was a real problem. The number of people unemployed for 27 weeks and over was 3 million out of unemployment of 5 million. So if we kind of get those ratios where 60% of the unemployed people are unemployed for long term, that's the trickle down effect on that is, again, more disenfranchisement, more marginal players, people who are not vested in the upturn in the economy, and that'd be a real problem. I think some of these restaurants, one hopes will come back in a different guise. I don't know, because I think a lot of people, maybe habits are going to change and eating habits and so on, which will make that industry look very different. But yeah, this is the thing to worry about. You'll get a spike back in employment for sure. You'll get people who are called back, they're ready to go. The employers can see the demand, and they can, and they've still got contacts with their ex-employees. But the ones which are lost permanently or for a long time, are a real concern.
Yeah. I think we have time for one question, and then we'll make this our last one and a good one. Are we making any changes to portfolios in light of stay-at-home stocks or countries?
Yeah.
Stocks.
A little bit. I mean, there are some obvious winners on the stay-at-home stocks. Rita, you already mentioned one, Zoom. Google. Yeah, these tech stocks are absolutely, nailing it. Something like Facebook getting a lot, what they call engagement time, which means, people are arguing even more vehemently than they do on a normal basis. But I don't know if they're buying anything more, or if Facebook can therefore, tweak up their ad rates. But yeah, there is some of that. I think, Amazon's done incredibly well, and then as has Costco, by the way, and Walmart, and some of these other consumer staple companies which have done well out of, the Cloroxes of the world. There's plenty of those. I think some of, we have invested a little bit more into those types of stocks, but we're not quite yet at the point where, the stay-at-home stocks, the companies that benefit in the short term. So Church and Dwight, nice little company, makes one of the best cleaning products on the market, called Kaboom. You've got to have a lot of confidence in your product if you name it Kaboom, right? Now, a lot of people bought Kaboom. They bought like 6 months worth of supply in April, May. So that's a short-term hit. I don't think it's a stay-at-home stock though. I think it's just, it did well, it will continue to do well, but it's not going to have 10% month-on-month annual growth. So we're buying some, but you've got to distinguish between what's changing permanently and what is a short-term bounce.
Great. Thank you. Carolyn, I think it's probably time to wrap up. We're way past half an hour. I can
read the disclosure, which I know people, they love this part. Okay. Look, thanks very much, everybody. Thanks for Debbie and Carolyn on our side, and Rita for making all this work on the day. Really appreciate that. And thanks everybody for listening. And if you have any emails or questions we didn't get to, feel free to email us or your financial advisor, and look forward to speaking to you next time. I'm now going to read the disclosure. Here we go. Discussions of the investment strategy and research investment process of Brown, Jankowski are the date indicators of the day of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the types of investments mentioned in this presentation will produce the intended results or outperform many other investments in the future. We reserve the right to change our investment perspective and outlook without notice as market conditions dictate, as additional information becomes available. Diversification does not protect the investor from market risk, does not ensure profit. Information is subject to unintentional errors, omissions, and changes without notice. While we gather the information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in the presentation. References to an individual security should not be construed as a recommendation to buy or sell that security. The security is noted in this presentation. Only several unsuccessful investments by Brown, Jankowski do not represent all the securities we have purchased, sold, or recommended. Index returns include reinvestment dividends and interest, but do not reflect commissions or transaction costs. Mutual fund returns, including reinvested dividends, capital gains, distributions. Mutual fund returns are net of the fund expenses, however, do not reflect Brown, Jankowski's fees. Please read the prospectus carefully before investing or sending money. Past performance is no guarantee of future results. We may reference various hypothetical investment illustrations. These are for illustration purposes only and not investment recommendations. Do not guarantee any indication of future results. Thanks, everybody. I'm going to click off here.